I'm Colleen. I graduated in 2001 and I started in alumni affairs just this last summer. But I also worked in the admissions office for 9 years. And Berkeley is my love. And I was lucky enough to go to school with Kari Carson. And Kari lives out in the LA area and is just doing phenomenal things with real estate out there. And so I was like, let's get you in front of an audience because there's always so many questions around this topic, and it's a universal topic, no matter where you live, what it is that you do, no matter, everything. And Carrie's got such a unique perspective because she's not only a Berkeley grad, she has her doctorate in music. She taught for a long time too. And as we all know, like that takes a certain skill set that helps with almost everything, being a former teacher myself. So, Carrie, you want to take it away?
Okay, yes. So first of all, thank you, Colleen. I so appreciate the opportunity to do this. I'm so excited to be able to talk to everybody tonight. Hopefully everybody can see my screen is sharing okay here. So just a little bit about me before we kind of dive in. So like Colleen said, I graduated in 2001 as well, again, dating myself, that I was a trombone performance major. And after I graduated, I moved out to LA with my now husband, who's a music engineer, and I did a master's at USC. I then came back to Berkeley and taught in the harmony department for 2 years, which I absolutely loved, and was hoping to stay at Berkeley long term, much like Colleen. But again, my husband needed to be in LA. So I moved back to LA. I got a doctorate in jazz studies from USC, and I was teaching at USC and several other colleges for, probably cumulatively about 10 years. But I started in 2011, I bought my first house. And I was really fascinated by the process, as a lot of people are. You're out there like surfing Zillow all the time. It says, wow, it's really fun. I remember watching House Hunters and thinking that was so much fun. Of course, I can't watch that show at all anymore. But I thought, well, I'll this will be something to supplement my playing with. And so I got my license in 2011, and I just immediately found that I loved selling real estate. A lot of the same skills from teaching really transfer over, which is basically what I'm doing tonight. Explaining the process is one of the main things that we do. So having that experience teaching really helped me to move forward in real estate. I do still play. If anyone on here is old enough to remember Kendrick Oliver's New Life Jazz Orchestra, we are still together. I do still fly out and play with them. So I love being able to do that. But for me now, the main way that I stay connected to the community is through helping musicians buy and sell. And I particularly love the buying side. So I'm really glad that everybody's here tonight to talk about it. First of all, I should say, so I am licensed in the state of California. I live in LA. I work the entire greater LA area, LA County, and a lot of the counties around LA County as well. So I'll drive quite a ways to help people. But my experience is only in the state of California. So I know people are logging on from everywhere. And actually, if you wouldn't mind jumping in the chat and just typing where you are, that would be amazing. Just so I can kind of get a feel for where everyone is. The process of buying a house does differ pretty significantly from state to state. So some of what I'm talking about tonight will be specifically California oriented. But I think that everything we talk about should at least give some good information to everyone, regardless of where you are. But just keep in mind that, some things may be different. So that being said, if we're looking at the entire home buying process, I usually like to break this into, I have 9 steps on here, but really I see it more as kind of a 4-part process. So the first part is these steps kind of 1 through 3, and they all sort of happen simultaneously. So getting your mortgage pre-approval, meeting and consulting with a realtor, and now signing a buyer representation agreement. So we will talk about this more. I will say, when we set this seminar up, I did not know that there would be a major settlement by the National Association of Realtors right before this seminar. And I did not know there would be headlines every day in the media saying, you know, it's the real estate apocalypse. A million realtors are losing their jobs. How is everyone going to do this? So I'll get in a little bit to that. But that is something moving forward that we're going to have to get used to as agents and also as buyers, which is that you are now going to be signing a agreement to work with a buyer's agent. So we will talk more about that. I know everyone's really worried about how that agent is going to get paid. It is going to be okay. So I will help kind of talk you through all that. But realistically, I don't think it's going to change nearly as much as what the media is portraying it as. So that's kind of the first step: meeting an agent, meeting a loan officer, getting everything set up. All of that needs to be done, I think, before you start actually going out and looking at houses. Then the second step, that's number 4 here, that's the actual home search, which is really the fun part. Hopefully it's not stressful. But that's, you know, obviously we'll talk about, you know, the process for that and criteria, how to select the right house for you. Then the next step is really writing your offer. That's a huge part of this, understanding what terms actually go into the offer, what you can change, how you can make your offer more desirable to a seller, what to do if you're in a market where there's just a ton of bidding wars. So we'll go through that. And then the last step, here in California, we're an escrow state. So that means that we use an escrow company, which is like a neutral third party that holds your deposit and coordinates all of your documents from when you get your accepted offer to when you close. So a lot of other states use attorneys for this, and I really don't have any clear knowledge of how that process works, at least not enough that I would be able to intelligently educate you on it. So that part will be a little bit different, and you'll need to, you know, discuss that process with your local realtor. But some of this should still transfer over. So we'll talk about what happens during escrow or once you have your accepted offer in terms of home inspections, how that works, disclosures from the seller, and also just what happens with your loan once you already have your offer accepted as well. And then the final step is just closing, really. And again, it's a little bit different in California than it is in other states. So I'll try to kind of touch on all of that. So diving in here, again, I will say most of the buyers that I work with have a tendency to just go out there and dive into the market and start going to open houses, start obsessing over Zillow online and looking at houses before they have any idea whether they can actually buy a house or what they would be approved to buy. So I understand that. I understand it's cool to start looking at houses and, oh, we'll just hop by an open house. We're not seriously looking. But if you even think that there is any chance that you would be purchasing a home in the next year or 2 years, it's not a bad idea to actually talk to a loan officer or talk to a realtor. And most of the time, I'd say people usually will end up talking with a realtor first, and then that realtor might recommend a loan officer to you. I do think that's a great way to approach this process. Now that we're going to be signing buyer broker agreements, that, you know, gives you a contract with a specific buyer's agent, it's really great to get that agent's input on a recommended lender, a loan officer that is experienced in your area, works with a great company, and oftentimes if that loan officer has a relationship with that real estate agent, that's really going to benefit you, because that loan officer is then not only working for you, but also working for that real estate agent, because that agent brings them potential borrowers. And so they're going to want to make sure that they're impressing not only you as a borrower, but also making sure that they don't put that agent in a position where their buyer isn't able to purchase a house. So it adds an extra layer of protection on for you that this lender is really going to do a great job. I personally have had a lot of experiences with just sort of random internet lenders who will give you an approval, but they will not explain the process to you. They're hard to get a hold of. They're slow. So it is, getting a good loan officer is, as important as getting a great realtor. You're not going to spend as much time with them as you will with your realtor, but it's important that you find someone that is going to answer your questions. So when you actually start talking with a loan officer and start looking at the process of getting pre-approved, the things you really want to think about are, what monthly payment are you comfortable with? So our monthly payments are usually made up of what we call your PITI. So that's the principal of your mortgage, your interest, your property taxes, and your insurance. And if you're in a condo, you want to also include your HOA dues on top of that. So all of that together is going to be your monthly payment. So you're really looking at what purchase price will put me at that monthly payment. So you don't want to necessarily always think about just, oh, I don't want to pay more than, 400,000, or in LA, 900,000, or wherever you are. You don't want to necessarily think about the purchase price as being your maximum. You want to think more about, well, what is my monthly payment? What is the maximum that my monthly payment is comfortable at? And so that's going to be a combination of how big your mortgage is and also how much money you're putting down. So you also obviously are going into this thinking, well, what can I afford to put as my down payment? And we'll talk more about kind of where that down payment can come from in a few minutes. So lenders, when they go to start your approval, the main things that they are looking at are your credit history, your debt to income ratio, and your assets. So credit history, lenders are going to pull your credit history. And I know this is kind of scary for some people because they worry that if their credit gets pulled too many times, it's going to ding their credit. If you're looking to shop for mortgage rates and you're contacting multiple lenders at the same time, there are some stipulations that will allow for your credit to be pulled multiple times for the same reason within a specific time period without it dinging your credit. So you can ask your loan officer about that. The other thing, if you're really worried about that, is sometimes we can have the loan officer look at all of your other documentation and just wait till the very end to pull your credit to verify. And credit is important because it will help to determine what type of loan programs you can qualify for, how much down payment you may need, and also your rate, your interest rate is often tied to your credit history and your credit score. So looking at credit scores, and again, I probably should have given this disclaimer up front, but I am not a loan officer. I'm not a tax accountant. I'm not an attorney. I am licensed as a real estate salesperson. So everything that I'm giving you now is based off my experience, being in the industry for 13 years. But you definitely want to make sure that you verify anything that I've said with your lender or whoever else. So credit history, if your credit is at 639 or less, I'm not going to lie, it's difficult. It's going to be difficult to actually approve you for something, unless maybe you have a lot of money to put down or, I don't know all the scenarios, but if you find out that you have low credit at the beginning of this process, it's okay. There are things you can do, and you want to talk to your loan officer about, well, hey, what is the easiest way for me to raise my credit? And sometimes it will be like, oh, okay, if you just pay off this part of your credit, then that alone will make a big difference. Or sometimes your loan officer might hook you up with like a credit specialist, and they will help you to clear things. Sometimes people have low credit because there's errors on their credit history. Or maybe, I don't think that, I'm not sure about medical costs, but sometimes there's collections that might be in there. So sometimes it's really just a simple paperwork issue can help to raise your score. But if you just truly, unfortunately have bad credit, talking to a loan officer now will help put you in a position to raise that credit and approve for more in the future. So, it's not that you're never going to buy a house, but you want to put yourself on the right path to getting that credit score up. And the other thing I'll say about that is that if you're buying with a partner, one of you has a credit score below 730 or 639, and the other partner has really excellent credit. You may decide to just have your loan qualification be under your partner's name only. This is very common, not just for musicians, but for everyone across the board. So maybe you're a stay-at-home mom, but your husband works. You don't have any income, so there isn't necessarily any need for you to be on the loan. If your credit is low and you don't have any income, there certainly isn't a need to be on the loan if you can qualify for what you want to qualify for under your partner's income only. So I will say this happens all the time. There's no shame in not being on the loan. Your name can still be on the title, but sometimes that's just a little trick we use to make the process easier if one person has really low credit. If your scores are 680 or above, then there's usually some way to make this work. Again, there's a lot of different types of loans. So you really want to talk to your specific lender about what can you qualify. There are first-time home buyer loan programs that can help you with rate, or might allow you to have a higher debt to income ratio, or might allow you to put less money down. I think there's a myth out there that you have to have 20% down to buy a house. That's not true. Not true. And also you can buy a house with, as little as 3% down and still have it be what we call a conventional loan. It just, again, depends somewhat on your credit. So, I'll have a lot of buyers who maybe make really great income. They have good credit, but they just don't have very much money to put down. So they may still qualify for what we call a conventional loan. And that would be versus like an FHA type of loan or maybe a VA loan, which is backed by the government. And those have sort of different rules for the way the loan processing goes through. But again, a typical FHA loan would be like maybe 3.5% down. A VA loan might even be nothing down. So if you don't have 20%, that's not a huge problem. We do loans all the time with less than 20% down. So don't worry about that. Debt to income ratio, that is where they will look at your income and they're going to look at all of the debt you carry. So that does include student loans, credit card payments, car payments, any, monthly expenses, any kind of debt that you are carrying. I believe it depends on the type of loan scenario, but I believe it's always between 40 and 50%. Your debt to income ratio cannot be over 40% for debt. So again, double check that with your local lender. But that's what they're looking at. And then they're going to look at your assets too. And this includes everything you have. So if you own other properties, if you have money in like a retirement, 401k or an IRA, if you have money in like a brokerage account, stocks, they'll look at all of that in terms of figuring out that magic number for your approval. In terms of how they verify all of these things, they always are going to look at tax returns. And this is where it gets a little tricky for musicians in particular, or anyone who's self-employed really. But if you are someone who is like a gigging musician, typically for most approvals, they're going to ask for the last 2 years of tax returns. I know there are some programs where if you have been working as a gigging musician for 5 years or longer, and that's your main source of income, they can use just 1 year of tax returns if you have that established history in the profession. So if you had a really great year last year, but the year before was not that great, then that might be a way to help your approval to get approved for more. But typically 2 years. I will say, just in a general loan approval situation, W-2s, if you're paid on W-2, that's the easiest, just most simplest way in terms of a paperwork for getting your loan pre-approval. Even if like you've just started your job like 2 weeks ago, if you're on W-2, then that is like you have a contract. It's a guaranteed income in the eyes of the lender. So basically you would just give your new contract to the lender and they will count that income as your yearly income, even though you just started the job. So it's really easy. I've even had people switch jobs in the middle of escrow. Please don't ever do that. But we were able to work around it, because if you're switching from one job to another job in the same industry and it's W-2 to W-2, even that can be done. So most of us as musicians are not on W-2. You're doing all kinds of different things. You're teaching private lessons, you're gigging. So if you are mostly on 1099 income and you use a Schedule C form for your taxes, that's pretty easy to approve with. You just have to have that paperwork ready. You have to have it done. I know a lot of people tend to, particularly us or self-employed people, maybe they wait a little bit longer to do their taxes. If you think that you might want to be buying in the next, year, get your taxes in, or better yet, have your taxes prepared and then give a draft of them to a loan officer to check. Because that's another situation for us, is sometimes when we're self-employed, we write off a lot of expenses, which helps with our taxes, but it also makes it look like you make a lot less money than you do. So sometimes a lender can give you advice on how to file your taxes to maximize your approval. And it might mean that you pay a little bit more in taxes that year, but it enables you to actually approve for something that you want. And then the following year, you go back to doing your taxes the way you normally would. So if you think, you want to buy and you haven't done your approval, haven't filed your taxes yet, just run them by your loan officer. It's never a bad idea. If you are incorporated, it's a little bit more complicated. You do have to show like a profit and loss statement for at least the last 3 months prior to your approval. So it's just a little bit of extra paperwork. And you might want to time this out. And I think this applies, for both, mainly for if you're incorporated, but maybe also for the Schedule C borrowers. Let's say that you have more of a seasonal income. So maybe you work on a lot of cruise ships or something, and so you make more money in the summer. You make the bulk of your money in the summer. What they're always doing is taking the overall amount of what you make in a year and kind of averaging it out per month. And so if you're incorporated, they're going to want to see that in the last 3 months, you've made around that average amount. So you might have to time your approval a little bit. Like if you're someone who makes all their money in the summer, then maybe you want to do your approval in the fall so that the last 3 months show a good cash flow for you. So that's another thing to maybe talk with a loan officer about. And this is why I always recommend talking with a loan officer way ahead. Like there's no harm in it. I know that this is the scariest part of this process because it's about your money and what you're going to owe. But there's really, just talking to a loan officer does not mean you are suddenly buying a house. It just gives you information, and it does not mean that you are buying now. Same with talking to a realtor. like coming to this seminar right now online does not mean you are buying a house right now. It just means that you're educating yourself for the future. So think of talking to a loan officer the same way. And really everything now for the application, it's all done online through secure servers. So it's pretty easy to just upload everything on and have a phone call with a loan officer. It's not like a huge time commitment. So if it's something that you're even just thinking about, it doesn't hurt to start talking to that loan officer to find out, what is the best way for me to structure my income or my taxes so that I can actually purchase in the future. Um, so for tax returns, you're going to be, giving a minimum of 1 year, but most likely 2 years. Bank statements, that's another way that they're going to, again, verify your income. They're going to ask for at least a minimum of 2 months bank statements to show your money coming in. And so again, hopefully if you're on here and you're even thinking about buying a house and you're way past this point, so please don't think I'm saying this in any kind of condescending way, but if you're, just out of Berkeley and you're just starting, as a self-employed person, it's always good to have that separate bank account where you're putting all of your business income into. You're depositing all of your business income into one separate account. And then from there, you're transferring from that account to your personal account to make your expenses. That makes it easier for you to show what income is coming in. It makes it easier for the lenders to approve that income. So hopefully, you kind of already have that set up. But if you don't, that's another thing to either talk to a loan officer or even a financial advisor, just to find out what is the best way to structure my accounts so that a loan officer can easily see what is coming in as income and how you can show expenses. All right, so down payment and potential reserve funds. So your down payment can come from your personal savings, or again, it can be pulled out of stock. You can pull money out of 401ks. You can borrow from them. That would be something to talk with your company that handles that account to see what their policy is on, how quickly you have to pay that back. But lenders will allow you to pull on any of that money for your down payment. They will also allow gift funds. And I will say probably 85% of buyers that I work with here in Los Angeles get gift funds. I mean, this is true of musicians, but of anyone really. I mean, in our area, like the idea that you at age 30 or even age 40 would have that much money put aside for a down payment, it is tough. So if you are getting gift funds from a family member, that is perfectly fine. A lender will allow that. They are basically going to need to see a paper trail of how that money is going towards your purchase. So first of all, it has to be seen as gift funds and not a loan. So basically, whoever's gifting you that money is going to have to sign something that says, this is a gift. There's no loan being paid back on it. It's a really simple, like 1-page document they have to sign. And then a lot of people ask me, okay, well, if I'm getting gift funds, should they just transfer those funds into my account? It's actually easier if, let's say, you're getting some gift funds from your parents. It's easier if your parents just hold on to the funds, and then once you have your accepted offer, at least again in the state of California, they would just wire that money directly to your escrow company without it ever having to go through your accounts. And the reason for that is it just makes it easier. Again, the lender has to have a paper trail for everything so that they know where the money came from. They're sourcing it. So they will basically just take a look at the account that your parents have, and they will say, okay, these gift funds are coming from this account to escrow. And it's just much easier that way. They don't have to then do the actual trail of moving from one place to the other. A lot of people are concerned about gift funds and, let's say again that you're getting gift funds from your parents, are your parents going to have to pay some kind of a gift tax? And I think a lot of people hear about there's a sort of a yearly amount that people can gift you without having to pay any taxes on it. And that's true, but I think, I'm not sure what they've updated to this year. I think it's like 17,000, something like that. Realistically, a lot of people get more than that as gift funds. So the main thing is to understand is that no, your parents are not going to have to pay taxes on any gifts they give you. You are not going to have to pay taxes on those gifts during the year that they are given. What happens is your parents will fill out like a gift form for their taxes and they will file it and it will go against their estate. And then when your parents pass away, if they have given over a certain amount, I want to say it's like somewhere between $3 and $4 million now, then the estate will be taxed. But most people are underneath that threshold, so they are not required to actually pay any taxes on that gift. So again, check with your tax accountant on that. But I have never encountered that situation here, and we use gift funds for practically every sale. So it really just depends on how big your family estate is. If you are getting gift funds from someone who lives overseas, then there are different rules about how long that money has to be in an account here in the US. They call it seasoning that money. It's usually 2 months. So just be aware of that. If in that case, it's probably better. Again, they can wire it directly to escrow in California. But you may want to just have those funds wired directly to you in that case a couple months ahead of time so that they are seasoned, just to avoid any kind of issue. I did actually have an issue with a sale recently where we had to close a little bit late. I was representing the sellers and the buyer's funds were coming from outside of the country and there was a hold put on the funds. So if you know that you're going to be getting funds from outside the country, you may want to just have whoever's gifting you those funds go ahead, send them in, have it be seasoned, and then that way you know there isn't going to be an issue with it. The other situation in which seasoning is important is if for some reason you're trying to get a loan and that type of loan requires that a certain amount of your down payment be considered your money. There are certain types of loans in which they will allow, there's kind of a cap on the amount of gift funds that they will allow. So the way to get around that is, again, to season the money. If your parents still want to give you a gift, they put it into your account, you wait 2 months, and after 2 months, that money is considered yours, right? Because again, the lenders are looking back at like the last 2 months of bank statements. So it's a way of making that money yours rather than gift funds. So this is all stuff that, again, you want to just find out about ahead of time so that you know and can be prepared ahead of time to deal with that. Okay. And so once you get all that documentation in, the lender is going to give you, they're going to say, hey, your maximum approval is this. So your maximum purchase price is this with this down payment. You want to basically get as much information as you can about the different scenarios that you qualify for. So a lot of people may qualify for a number that they are not comfortable actually paying. So that's why, again, it's so important for you to understand what is your monthly payment going to be rather than always thinking of it in terms of what is your purchase price. People get really hung up on, I'm just not going to pay that. That's too much. I'm not going to pay a penny over 500K or whatever it is. But they don't realize what their actual monthly payments are. And like going up $10,000 raises your monthly payment by like $20 a month, maybe. So it's really important that you do understand that breakdown when they give you that qualification and how, putting different amounts of down payment might affect that. Sometimes we can also use kind of tricks, like let's say that you only qualify for a certain mortgage amount because of your debt to income ratio, but you are able to come up with an extra $10,000 of down payment. In that situation, you could just put more money down, keep that mortgage amount the same, and you're able to go up in price. So again, these are, just more things that you want to get as much information as you can about before you really dive into your search. I get a lot of questions about closing costs. So this is something that you can easily forget about. And that is that you need to have money set aside for your closing costs separately from your down payment money. So closing costs are going to vary quite a bit. Again, this is why you want to get as much information as you can about this ahead of time. But really what they're made up of is fees that are kind of set at closing. Sometimes these are negotiable fees, but otherwise they're sort of set fees. And then they're what we call prepaid fees that are really your cost of home ownership that you're just paying up front. So for closing fees, there's, in the state of California, again, there's an escrow fee. I would assume that's the equivalent basically of your attorney fee in attorney states. There's a title fee. This is your fee for title insurance. And again, I don't want to go too far into this because I could really go down the rabbit hole on a lot of this stuff, but title insurance is basically an insurance policy that protects you in the event that you buy a house and then a year later someone shows up and says, hey, I actually own this house. The person who sold it didn't have the right to sell it. Or someone coming and saying, hey, you can't put your pool there because that's actually part of my property. So title insurance does protect you. It's a one-time fee. It's not a yearly insurance policy. It's a one-time policy that you buy when you purchase your home. And so that's a set fee. And typically, like both in the state of California, both escrow and title fees are split evenly between the buyer and the seller. There's also a loan origination fee. That's just the fee that you're paying to your lender on behalf of them putting your loan together. And then there's an appraisal fee. So if you're buying a house with a loan, you're going to be required by the lender to have an appraisal to make sure that you're not paying more than the home is worth. So that's actually, aside from any fees that you pay for inspections, which we'll talk about in a bit, the appraisal fee is the only closing cost that you actually pay up front. So let's say you get an accepted offer and you're moving forward on purchasing that house, you're going to pay that appraisal fee up front so that the appraiser can get paid. If the appraiser goes out to do the appraisal for you and then you change your mind later, that appraiser still needs to get paid. So in California, the fee for appraisals is usually between $500 and $900, depending on the size of the house and the purchase price of the house. So other than that, all of these other closing fees, these you won't pay unless you close on your house. So it's really just this appraisal fee that gets paid up front, and everything else, even all your prepaid stuff down here, that is only paid if you close. So the prepaid fees, these are additional fees that are tacked on, kind of basically, they're tied to the type of loan you have. So let's say that you need to get a lower interest rate than what you currently approve for in order to purchase at the price you want. You can pay points. That's basically just a lump sum to lower your rate. And so sometimes that will be included in your closing costs, that you're paying, $2,000 to lower your rate by 1/4 of a point or something. And then the other prepaids are really like, there's a couple different ways that you can pay your mortgage. Most people have their mortgage paid through what we call an impound account. And this is where basically the mortgage provider collects your principal, your interest, your taxes, and your insurance all together each month. But in reality, in the state of California, at least, again, your property taxes are only due twice a year. So they basically take that monthly payment and they put your tax money in a separate account and then they pay it for you. So sometimes what I would recommend looking into, as if you're self-employed as a musician, or, I do this because I get paid a different amount a different amount every month, is if you can qualify for it and it's not required for your loan, you can also pay your property taxes and your insurance separately, not in your monthly payment. So you're going to pay a lump sum twice a year for your property taxes. And in the state of California, property taxes are a lot. So that can often take a huge amount off of your monthly required mortgage payment. So it's a way of kind of tricking yourself into feeling that your monthly payment is lower than it actually is. But you have to remember then to personally put that money aside. And so that's what I do. I just put money into a tax account, and then twice a year I pay it myself out of that account. Some people like the idea of feeling like they are in control of when their taxes get paid, that if there's any interest accrued on that money, that it's going to you and not your mortgage lender. And also that your required monthly mortgage payment is lower. If you're someone that's worried about, not being able to make your mortgage payment, it's easier to take the lower required payment because, your taxes, it's a little bit easier to get extensions on those and that kind of thing. So that's something to ask your lender about as well, particularly for self-employed people. That can really help, I think, just with your monthly payments not feeling so overwhelming. But if you're someone who just cannot save or doesn't even want to think about it, then you'll have all of that money together in one lump payment. Getting back to how this actually relates to closing costs is, if you are doing that impound account and the lender is going to pay for your taxes, your insurance, and your interest on behalf of you, they are going to have to pre-collect a certain amount of that up front. I think it's usually at least 6 months, can be up to a year, that they have to collect up front in order to start that impound account. So if you are doing it that way, your closing costs will be higher. If you are not doing an impound count, then your closing costs could be significantly lower. But again, you're going to have to pay that upfront. So also prepaid fees, your interest. So in the state of California, mortgages are paid what we call in arrears, which means that you're paying at the end of the month for the month that just happened, as opposed to like a rental amount where you pay your rent on the first of the month and it's a prepayment for that month. So let's say that you are closing on April 3rd. You actually won't, so your house is closing. You're actually become the owner of your house on April 3rd. You will not make a principal mortgage payment until June 1st. It's a way of kind of giving yourself a little break after you just came up with all of that money to close, and helps a lot of people that you don't have to make that full payment again on May 1st. But if you close at the beginning of the month, what you will prepay is your interest from April 3rd to June 1st. So this will depend on, where in the month you close. If you're closing towards the beginning of the month, your closing costs will be a little bit higher because you're prepaying more interest. If you close towards the end of the month, your closing costs will be lower, but you will have less time in between when you close and when you make your first mortgage payment. So again, closing costs, they can vary. So it's really important for you to talk to your loan officer. I will say, just from my experience here in California, the closing costs are typically anywhere between $10,000 and $20,000. So it's a pretty good chunk of money that needs to be set aside separate from your down payment. And there are sometimes ways that we can, get the seller to pay for part of your closing costs, or we get credits towards your closing costs. But I will say, in very competitive metro areas like Los Angeles, it is difficult to negotiate that up front. We're more likely to get a credit due to something that happens during escrow. So again, you just really want to be aware of what you'll need for closing costs versus what you'll need for down payment. Okay. Does anyone, I don't see, if anyone wants to type in questions here in the chat as we're going along, please feel free to do that and I will try to be aware and be looking at them. But otherwise,
I'll keep you updated if anything shows up.
okay, perfect. Otherwise, I'm going to move on to the next step, which is your buyer's consultation and representation agreement with a buyer's agent. Okay, so first of all, a buyer's consultation. That's just essentially what I'm doing with you now, except you're doing it in person with an agent. So again, there's no reason to avoid talking to a real estate agent if you think you might want to purchase a house sometime soon. I know that we kind of tend to get a bad rap in the media or in entertainment. You know, there's usually like a couple different ways that realtors are portrayed. We're either like that shark negotiator who's on like Selling Sunset or whatever and is going to come in and like yell at someone over the phone. And that may not be the kind of person that you really want to hang out with and spend a lot of time with. Or we might be that sort of goofy real estate agent who like wears a bow tie and shows up at your house with like a magnet and is bothering you all the time. Those are stereotypes. That's not who we actually are. And so there's really no reason to be afraid of talking with a real estate agent. Again, just like with your loan officer, just because you're having a meeting with a real estate agent does not mean you are buying a house. And it also does not mean that you are tied to that agent as of now. That's partially why these buyer consultations are going to be so important, because we do have a settlement pending from the National Association of Realtors due to some lawsuits that have been filed. The initial lawsuit was really from sellers, and they basically said, hey, we just kind of realized that we are paying buyer's agents and we don't really want to have to do that, or we don't want to have to pay them as much as we are. So I think understanding exactly how realtors are paid, first of all, and what a realtor's value to you is what, unfortunately, the industry was not very good at explaining upfront. And that's why we're in this situation, because we as an industry did not explain well enough how we are paid. So again, I don't want to spend too much time on this. There's a lot of, developments and the settlement is not even approved yet. But basically in California, at least, and again, this is something that is different from state to state, but in California, the way that buyer's agents have been paid for many, many, many years is through what we call cooperative compensation. So that means that when a seller puts their house on the market, they sign a listing agreement with their listing agent. And as part of that agreement, they would agree to an overall commission, and they would agree to how that commission is split. So a portion of that commission would go to their listing agent, and they would pledge a portion of that commission to go to the agent who is representing the buyer. So even though that buyer's agent doesn't represent them in any way, that is how the buyer's agent has been paid for many years. And the benefit of cooperative compensation is that you as a buyer did not have to come up with additional funds in order to pay your agent. That being said, the reality is that you were paying for your agent in the sense that you bought the house and the seller paid the agent out of the proceeds of that house. So really, the seller wasn't, you were both sort of equally paying that commission, really. And again, it's sort of a hard concept for people to understand, that, a buyer's agent is working for you, but getting paid by the seller. But that is how we have been paid for many years. Going forward, that probably will not change in a lot of markets. So that's the first thing to note, is that you're seeing a lot of headlines here saying, oh, the 6% commission is dead. It's a real estate apocalypse. I don't think that, I think the changes are going to be much more minimal than what we are seeing in the media headlines. So basically, in California, we were already allowing sellers to negotiate commissions. It was never required that a seller pay a buyer's agent on behalf of the buyer. That was always negotiable. And so that doesn't change. Buyers or sellers can still choose to pay the buyer's agent on your behalf. And I think that's probably what is going to continue to happen, at least in the state of California, in the LA area, for the foreseeable future. So I know a lot of people are worried, they want to buy a house, but they don't have to come up with an extra, however many thousands of dollars to pay their agent. So understand that the first thing is you will never be required to pay an agent without knowing ahead of time exactly what you are paying and agreeing to that payment. So the way that this is going to work is that you are going to meet with a buyer's agent, get to know them, and before you actually go out to see properties, you will sign a contract with that buyer's agent that will spell out in very clear terms how that agent will be paid. So if you see on here, these are the essential components of the contract that you will be signing with your buyer's agent. It will explain very clearly what are the scope of the services. So this is all going to be negotiable. If you want to have an agent that literally just opens the door for you to see properties, you could potentially negotiate an agreement with an agent that that's all they're going to do. They're going to meet you and open up doors, and that's it. And you would give them some kind of flat fee for that. Realistically, most people need a lot more help than just getting in to see properties. And I think that there's still a lot of confusion over what buyer's agents actually do. And so that's something that we as an industry are going to be really working on helping people to understand. I was thinking about this, and I understand the confusion, because I remember when I was at Berkeley and I had an apartment on Hemingway, and the process was literally I think we walked in off the street into a real estate agent office and said, "Hey, I'm looking for an apartment." And the agent was like, "Oh, I have one available here. Let's go see it." Literally, we just walked in, walked out, walked over, saw the apartment. I said, "Okay, I like this apartment." I wrote an application, and then that was it. And I had to pay that realtor 1 month's rent. I don't know if that's still how it works in Boston, but
Yes, it
it's
is. Yes, it is.
okay. That's
It's horrible.
incredible. I will tell you that's not the way it works here in Los Angeles. And if it was, you would see a lot more agents doing leases here in Los Angeles, because I can understand how that seems kind of ridiculous that you're paying a full month's rent to someone who you're spending maybe 10 minutes time with. But I can assure you that buying a house is a totally different experience than getting a rental. So this is a case where you really, really do need a professional working with you throughout this entire process. And I'll talk more about kind of what exactly we do. But there's a reason why, buyer's agents deserve to be paid, and that there's a value to what they do. So that's going to be agreed upon within this representation agreement. So you're going to agree on what is your buyer's agent going to actually do for you. You're going to agree to certain types of properties. So it is going to be possible for you to sign a buyer's agreement with an agent just to show you one house. Okay, so I know particularly during the pandemic, and maybe even a little bit before, I noticed a trend of people going on to Zillow, looking at houses, and then there's like a little button that you can click and it just says, "See this house now." And so you click on that button, and then miraculously, a real estate agent calls you and says, "Hey, I hear you want to see this house," and you can just go see the house. First of all, know that the agent calling you has paid Zillow to pass your information along. So it's not based on any kind of like expertise in the area or anything like that. It's based on who's paying Zillow to get those leads. And so a lot of people, because of this, and because of, people do this with Redfin too, they feel like, oh, I want to go see this house. I don't want to have a relationship with a realtor. I just want to get in to see the house, and it's not an open house, so I need a private showing. That is probably going to be a little bit harder to do. It's better for you to start a relationship with a buyer's agent and to do showings with that agent. And really always has been better, because you really want to develop a relationship that progresses together. If every time you see a house, you're using a different agent, then you're not really getting any kind of cohesive guidance from that agent. So I suspect that maybe people will start clicking on that button a little bit less once they understand that, okay, when I go see something with this agent, I'm gonna have to sign something with them that spells out how they will be compensated if I end up wanting to buy this house. But that being said, you can sign an agreement that's just for one specific house. You could sign an agreement with that agent that lasts a week. I would suspect that most agents are going to want you to sign an agreement that is maybe a minimum of 3 months. But again, it's up to you and that agent, and all these terms are negotiable. So the most important, and just one more thing on that. If you're in a big city like LA and you're looking on the west side and also on the east side, it's possible that you may have 2 different agreements, one with a west side agent and one with an east side agent. And as long as those 2 agreements are not in conflict with each other, you can still do that. If you're looking specifically for like agents who specialize in one area, that again could be spelled out within that agreement. And then the most important part is compensation. So again, part of the terms of the settlement is going to be that if a seller is willing to pay a buyer's agent on your behalf, that offer of commission will not be made public through the multiple listing service. Again, that doesn't mean that the seller is not going to be willing to pay your agent out of closing. It just means that we have to do a little bit more work to determine whether or not that seller is going to do that. So what you will do for this process with your agent is you will sit down, and maybe that agent is going to say, okay, my fee as a buyer's agent is 2.5% of the purchase price. That's really common in our area. This whole thing about the 6% commission being dead is, at least in LA, it's very unusual that sellers would be paying 6% anyway. So that again is just sensationalization. But if you were to agree in your buyer broker agreement to say that you want that agent, your buyer's agent, is going to get paid 2.5% of the purchase price, that is them being paid somehow. It does not mean you are paying them out of your pocket. It means it's either through the seller continuing to pay your agent's compensation, or a combination of maybe the seller will pay 2% of the purchase price and then you will bring a 0.5% in, or whatever you can negotiate with your particular buyer's agent. When you make your offer, what I think most buyers will do is there's a box in the offer contract that you will check that says, we are asking that the seller cover the cost of our buyer broker agreement. And you will attach a copy of this buyer representation agreement with your offer so that the seller knows exactly what you have agreed to. And then the seller can answer back and say, okay, yes, we accept your offer and we agree to pay your agent on your behalf out of closing. The seller can also say, no, we're not going to pay your agent. And this is going to be something that as an industry, agents, we are going to obviously try to find this information out ahead of time so that we don't put you through the entire process of making an offer and getting super excited about the house when you don't have the money to pay your own agent. And then to find out, no, we won't accept it unless you pay your agent. So we're going to be working to try to make sure that this process is streamlined as much as possible. And I will say it is possible that you could also request, hey, I don't even want to see houses in which I would have to pay you any commission out of my own pocket. In which case, we would just only look at houses in which the seller is offering a certain commission. So we're going to have to get used to how this is all going to work. But for now, at least in LA, I think the majority of sellers are going to continue to pay the buyer's agent just the way we did before. So I don't think it's anything to really be very strongly concerned about at this point. And we're going to just kind of have to see how it all plays out. But just know that you're never going to be in a situation where you unknowingly agreed to have to come up with a big sum of money to pay your own agent. You will always know ahead of time what you are agreeing to. Otherwise, you just won't purchase that house and you'll move on to another house. Okay. And then I'm not going to go through all of this, but this talks a little bit about what a buyer's agent actually does. And it is important for you to know, again, I think there's the perception that we just open up houses and you walk in. And it's funny, I can always tell. Sometimes I'll be at houses with my clients and we're waiting for one agent to come out. And I can always tell when that agent is a click the button agent. Maybe it's Redfin or Zillow or Purple Bricks or whoever it is. And I can always tell because the agent is standing outside on their phone while their clients are touring the house by themselves inside. That's not an agent who is working on your behalf. I'm always inside the house with my clients. We're talking about it. We're looking at it. We're thinking about all of the possibilities. Like, this is not, my job is not just to open the door for you. And even showings are such a small part of what we do. Keep in mind that buyer's agents often work for, many months, 6 months, common. Although I would say most of the time it's shorter. But I have had clients I've worked with for multiple years before they bought a property. And so buyer's agents are, we're setting up appointments. We're going out with you in person to see each home. We're also providing you guidance on every home. Oftentimes, during 2021, especially, maybe there were some clients where, I've written like 7 offers for one client because they were in a really tight price range and it took us that long. So there's so much that goes into representing a buyer. It's actually, I think, a much more difficult process than representing a seller. And it's a lot more nuanced of a skill set because particularly for buyers, your agent is really in many ways like your therapist throughout this. I have had buyers who I literally thought they were going to get divorced during the process, that it was just so stressful. They couldn't even be, this was during COVID. And so we were doing a lot of things like over the phone and they couldn't even be on the same phone call, like in the same room. They had to be like in different areas of the house. And so, the agent then becomes that person who has to really adapt to everyone's personality and figure out what that person needs to understand the process and feel comfortable moving forward. And also, your agent is your safety net throughout this process. So part of why we get paid is because we take on liability for your purchase in a similar way that you do. So let's say that something goes wrong during your transaction and later on there's a lawsuit about it. Your agent could very well be named in that lawsuit. We're taking on, that liability on your behalf. So there's a lot that we do to help you throughout a very long process. So know that that is partly why the agents get paid what they do and why it's important that they are paid. If you're going to take on that kind of legal liability on someone's behalf, you can't do that for free. And also, of course, buyer's agents only get paid when you actually purchase a house. So, if you have clients that are looking for a year, making a ton of offers, and then they say, oh, you know what, we're going to move to another state and we're not going to buy, that buyer's agent never gets paid for any of that work. So it's just something to keep in mind as you're talking about compensation with your buyer's agent. Okay, we are through that. I'm going to look. I see one question in here. Maybe I'll take that.
I don't see any questions.
Oh, I see it.
What the?
So Demetrius, is that
Weird.
right? In terms of debt to income ratio, would you recommend that we meet with a loan officer before we take actions like starting a new car lease? Excellent. Excellent question. Yes. If you think you want to buy a house anytime in the future, definitely talk to a loan officer before you get a new car lease. Because I will say car leases are one of the number one things that can mess up your debt to income ratio. And a lot of times, I was talking a little bit about like things you can do to improve your credit or your approval. A lot of times, in order for you to get a certain purchase price number, you'll have to pay off your car lease in order to get that. So that's a really good question. Definitely think about that before signing another one, so that you kind of know how that might affect your debt to income ratio. Okay, I don't see any more questions as of yet, but we will definitely talk more at the end as well. So now we're into the fun part. I know that was really dry. Thank you everybody for sticking with me. I'm going to take some water myself. But that stuff is so important to get through up front. So everything that we just talked about should take place before you ever see a home. I know that sounds ridiculous, like, because we talked about so many things, but really, especially now that you have to sign an agreement with an agent before you even go see a house, all of that really needs to be done up front before you start going in to seeing houses. But once you get all of that out of the way, then you're prepared. And that means that if you go to an open house, if you go to see a house with an agent, you could actually buy that house. You're ready. Because I can't tell you how many people just go into an open house and they're like, wow, this house is awesome. I want to make an offer. Oh, offers are due like today at midnight. They haven't done their loan approval. They have no idea if they don't have an agent, like they don't have a loan officer. It's just so much easier on you if you do all of that up front. Once that is done, then you can actually get out there and start seeing houses. And it is important too, really important to do all of that before you see houses, because you want to know what your price range actually is. People make the mistake of going to see open houses before they know what they can afford. And the more houses that you see before you know your approval, the greater chance it is that you're going to be approved for less than those houses, and those houses are not going to look great in comparison. So it's really important that you only look in your range that you're qualified for. And particularly in highly competitive areas, you may even need to be looking a little bit below the top of your budget to allow yourself room to move up in the event of a bidding war. So that, again, will depend somewhat on your price range and, whether it's a super competitive price range or not. But once you know your budget, you're going to get out there and actually start looking at things. So important things to be considering as you're going through your house hunt. First of all, location. I think this has to be number one because it's the only thing that you really can never change. And if you're buying with a partner, please make sure you are both on the same page about this. I think it's so important for couples to see houses together whenever possible. I've had so many circumstances where one spouse is really busy at work and the other spouse will say, or not necessarily even spouses, just partners, might say, okay, well, I'm going to go tour all of these properties and then I'll tell you what like the top one is. I don't recommend that. It's not a great idea because you have to see the whole range of what is out there in your budget in order to really get a good understanding of what houses are going to work for you and what you can afford. So seeing, and also just finding a house that you really like. It's a lot of it is really by comparison. So if you have one person that is seeing all the bad houses and they realize, oh, wow, this house is so much better than those other houses, but that other partner has not seen the other houses, they may think, well, this house is not that great, but that's because they haven't seen all of the other homes to compare it with. So it's important, I think, that as much as possible, you see houses with whoever has a stake in deciding on the house. So sometimes someone might be co-signing a loan. I didn't talk about that, but that's another that's another possibility for if you cannot afford what you want, you cannot be approved for what you want, but you have a family member who is willing to co-sign a loan for you. That's another way that you can purchase and get more money for your approval. So see houses together, location, research the location ahead of time. This is so important because people will look at houses on Zillow and they'll be like, oh, wow, this house looks so amazing. And I keep saying Zillow, but really you should be looking at the Compass website because Compass is great. So you really cannot go buy the home alone. You want to make sure that you understand the neighborhoods because everyone has a different comfort level for where they live. And there are so many deciding factors. So how long is your commute going to be if you don't work from home? How long is your commute going to be? What are you comfortable with? People ask me all the time, is this neighborhood safe? I cannot answer that question for you. I mean, legally, I can't answer that question for you, but also just personally, I don't know if my level of safety is the same as what yours is. So you really need to do some drive-bys. Spend some time in that neighborhood if you aren't familiar with it, because a lot of people will think, oh, wow, this area has a ton of houses in my budget, but they've like literally never been there. Like that is not a good idea. You want to make sure that you drive around. What amenities are you going to be using? Do you have kids? If so, or are you going to have kids in the future? What are the schools like? I know that's really important to a lot of people. And then really you just want to ask yourself what type of neighborhood it fits your lifestyle right now. Remember, the concept of buying your forever home is really outdated, particularly in these expensive metro locations. So it is highly unlikely, and maybe this is true in the middle of the country or in cheaper markets. Again, I'm speaking only for Los Angeles, but I will say here, almost no one buys their first home and just keeps that forever. You're using that first home as a stepping stone to get to your forever home. I did it myself. I bought my first home in 2010, 2011, right before I got my real estate license. I sold it 10 years later for more than double what I paid for it. And I used that to then get what will most likely be my forever home. So it's a stepping stone. So you're buying for the neighborhood that you want now, knowing that later in life you might want something different. So maybe right now you want a more urban environment where you can walk to coffee shops and things like that. But in 5 years, you might want something that's more suburban or quieter. So you really want that location to fit what is going to work best for you now. And so make sure that you really research that ahead of time. And obviously your agent is going to give you a lot of recommendations. That's one of the main things that I do as a buyer's agent is they'll say, oh, we're approved for this much. What are the best areas for us to target with that budget? So a lot of what I'm doing is helping people to understand areas that, based on the criteria and what they've told me they want, I sort of help to, be a matchmaker for them and specific neighborhoods that maybe they aren't familiar with. But they still need to go and do that research on their own, to drive through at night if you're worried about safety, but understand, the ins and outs of those neighborhoods so that you're not convincing yourself because you love the house so much that you love the neighborhood. It's hard to do that. And that's one of the main reasons why people sometimes change their minds. After getting an accepted offer, they'll be like, you know what, this is just really too far for me to commute, or I just really am not comfortable with this neighborhood. Not to call out any neighborhoods in LA, but I will say I work with a lot of buyers who end up buying in Santa Clarita. If you're in LA and you understand this area, it's great for first-time home buyers because it's a lot cheaper. And, you know, you can get more for your money there. But a lot of people are like, oh, it's not hip enough for me. It doesn't, it doesn't fit my lifestyle. And so if that's the case, we don't want to look there. Like we can't make it work for you. So you need to determine that for location on your own first. All right. Your home wish list. What are your wants versus your needs? So everybody does have specific needs. And for musicians, our needs are pretty particular in some cases. So I can't tell you how often I've worked with drummers and they really need that extra space where they can make noise and not be bothering someone. Or engineers, we need a detached garage because that's going to be my studio. So that might actually not just be a want for you, but that may be a need for you. So it is important for you to kind of single out what are your top three, what are your must-have items versus what are your compromise items that we want this, but we understand we may not get that. If you come into this process with too specific of a list, you are going to be really disappointed because there is no house out there that has every single item that you were looking for in a house that you can afford. I mean, I don't think I have ever had that happen because there's just so many things that people want. And houses are really different, honestly. You're going to go through this process and you are going to realize that what I like to say is houses are not soulmates. There are lots of them that could work for you. So there's going to be tons of houses out there that you could see yourself living in, and there's going to be different compromises for each. So ultimately, you have to decide what type of compromise that you are comfortable with. So going through it, know, what are your number of bedrooms and bathrooms that you need? Square footage, people oftentimes will say, okay, well, I have to have this amount of square footage. It's good to have an idea of how much space you need, but don't necessarily cut off. Like in your online searches, don't say, okay, I'm not going to look at anything that's under 1,000 square feet, because maybe there is a house that's, 950 square feet and it actually works out really well because there's more space in the, entertainment areas and less in the bedrooms, and you're okay with that or something like that. So it's really you should go more by floor plan and less by square footage. Here again, garages, if you need a detached garage, we have a lot of houses in LA with detached garages, but I know around the country, garages are used differently. So if you live somewhere where it snows a lot, you might actually really need to park your car in your garage. Nobody parks their car in their garage in LA. I mean, nobody. It is always used as a storage space or a converted space. Nowadays, people are converting their garages to ADUs, which is an accessory dwelling unit, like a little guest house. So that may be something that you specifically need. And then again, how much of a yard do you need? Now, one of the major questions, and this really ties in a lot to your approval, is, are you going to buy a single family house or a condo? Musicians are going to want single family houses. I understand it. I know that you don't want to bother people with noise. It may not be in your budget for your first house. And so you may need to figure out how to make a condo work for you so that you can, in 5 years, maybe less, depending on, how the market appreciates, you can move into a single family house at that point. So maybe there are types of condos that could work. If it's a townhouse maybe, or if it's an end unit, something that has a separate garage, which we come across sometimes. Keep an open mind about condos, especially if realistically there is nothing in your budget for single family. There's usually a way for people to make condos work. So again, remember that you're either compromising on elements over here, or you're compromising on location for your budget, or you're agreeing to pay more money than maybe you originally wanted to. So you're making a compromise on something. Keep in mind that if you do purchase a condo, it's going to affect your approval a little bit. So basically, your lender will give you an approval for a single family home, and they'll also give you an approval for a condo that the purchase price is lower, and that's because it wraps in your HOA dues. That's a separate cost on top. Also, be aware that with condos, the interest rate can sometimes be higher than with a single family house. So again, you want to kind of go through all of your options with a lender. But condos are a great way to get into the market, start building appreciation, and then move on. So don't be too disappointed if realistically a condo is the best step for you at this point. Okay, another thing to be on the same page about with your partner is the condition of the home. I can't tell you how many times I have had one partner who is like obsessed with buying a fixer, and they want to save lots of money and you know, essentially sort of flip the home. That's great. I love buying homes for cheaper and having you build that equity yourself. But you have to be realistic and you have to be in agreement between the two of you as to how you can accomplish that. What a lot of people don't understand is that they think they can buy a fixer home and just say, okay, I want to add an extra $40,000 to my mortgage and use that money to do repairs or renovations. You can't do that. There are construction loans that are designed specifically for that, but as a first-time home buyer, I don't recommend that. It's very complicated, and the way it works is you have to actually have chosen a contractor during your escrow process, and they have to have drawn up a whole proposal for the work, and then the lender pays that money directly to that contractor, and there's timelines involved. It's very complicated. So it's not like you're going to get a mortgage and then you're just going to end up with $40,000 in your bank account that you can use to renovate the house. So if you do buy a major fixture, just make sure you know where the money is going to come from for you to actually do those repairs. I always recommend that you buy a house that you can actually live in for maybe a year while you decide what to do with it, and then do it. If you're going to buy something that has to have work right away, you need to make sure that you just have a good plan for that. And decide what kind of renovations that you're comfortable with. So, like this one here. So this is a house I sold. I was representing the seller. This is very simple. This was just, we painted the cabinets, we painted this ugly brick here, and we put in a new floor. That's not particularly expensive, and you can even do it yourself. We swapped out the hardware, but look at what a big difference that made. So, you know, doing some renovations yourself is to be expected. I will say that on any home you buy, you're probably going to want to paint, and you might want to swap out flooring. But just be prepared and ready if you want to do more major things like actually redoing a full kitchen or bathroom, or moving walls, or getting into actually like tearing things down or doing additions with permits. That can take a long time. Are you going to live in the house while you do it? Or are you going to have to rent another place while you do it? Just make sure that you understand all of that ahead of time. Okay, once you find that house that you want to make an offer on, these are the items that you will need. So you're going to need your purchase contract. So again, your agent is going to prepare that for you based on the terms that you agree upon. And your agent is going to give you, your buyer's agent is going to give you a lot of guidance at this point. They're going to pull all of the comparable sales and actually help you to understand how they compare to the house. You know, it's one thing to sort of look up other sales in the neighborhood, but you sort of have to know the ins and outs of why did this house sell for more, or why did this one, you know, not sell for very much, or why was this on the market a long time and this one wasn't. All that has to be taken into consideration when you're putting together your contract. You need to have your pre-approval letter from your lender, and you need to show, and again, this is in California, so could be different in other states, but I would imagine most of this applies. when we submit offers here in LA, we submit with what we call proof of funds, which is a bank statement showing the proof of your down payment. And oftentimes when it's really competitive here, I will tell people, give me a bank statement for every account you have. We want to show them that you have extra money beyond what you are just using for your down payment, so that it shows the seller that you are that much more of a qualified buyer, and that you're not using your last penny to purchase the house. So you can black out the account numbers, but these are the 3 items that we always submit with. Your contract, that's your offer, your approval letter, and your proof of funds. Now, there is a lot of controversy over surrounding buyers writing personal letters about themselves. I know that in some states, it's actually not legal to do that, not legal for sellers to read them. Here in California, sellers can still read these letters. And the reason that some states have moved away from that is because they're worried that personal letters can include details that would inadvertently put you as a buyer in a position of being discriminated against due to you being in some kind of protected class. My experience has been that personal letters help sellers to better understand your motivation for purchasing their specific house, so that they know there's a reason why you want their house and not just that you're throwing offers at every house. So, most buyers here will still submit personal letters just to introduce themselves to the sellers and say what they like about the house. It's not about you being the same type of person as the seller. It's about them just getting a sense that you'd be nice people to be in a transaction with. But that being said, sellers can choose to say, no, we're not going to read any personal letters. And in that case, we just wouldn't submit one. But it's not a bad idea to maybe have a personal letter kind of templated up, a template for a personal letter. And then when you find your house, you just pop in some details about that house. All right. So the elements of the offer. These are the parts of the offer that you can actually change. Much of the purchase contract is just boilerplate legalese. So there aren't that many things actually as a buyer that you can change. So it's important that you, it's difficult to go up in price, right? So you want to try to make all of the other elements of the offer slant as strongly in the seller's direction as you can to compensate for the fact that maybe you don't have a lot of room to go up in price. So price is the most important generally, and that will be determined based on your conversation with your buyer's agent as to, how much competition is on the house. Is it priced low in order to initiate a bidding war, or has it been sitting on the market for a long time? All of that discussion is going to go into crafting your strategy for what price you want to submit. You're going to put on your offer the amount of your loan and your down payment so that the seller knows how much you are putting down. This is always kind of hard to understand because regardless of if you're putting 3% down or 20% down, the seller is going to get the same amount of money. But anything below 20% down is considered a riskier loan. And another thing that I probably should have put in there earlier is that if you're putting less than 20% down, you're going to be paying what's called private mortgage insurance, or PMI. It's an extra cost towards your monthly payment, just to kind of give your lender an insurance policy, because you're considered a riskier lender because you have less money in reserves. So because of that that cutoff threshold for 20%, sellers will perceive offers with a lower down payment as being less secure buyers, even though they get paid regardless. It's not the case, but if you have a really low down payment, this is where maybe you will adjust some of these other things to try to compensate for that in the mind of the seller. And there's lots of things that we can do to try to, again, make you seem like a stronger buyer. So again, in the state of California, you have an initial deposit that will be staged in the contract. And for us, it's 3% of the purchase price. So if that is your down payment, your deposit is your entire down payment. That you will get back if you change your mind and do not purchase the price. Do not purchase the house, you will get your deposit back. But this is what has to be put. Sometimes it's called earnest money, your earnest money deposit. It basically shows the seller, hey, I'm serious enough about the house to buy it that I'm going to put a deposit into this escrow account so that you know I am moving forward. That money does not go to the seller, at least in the state of California. It goes to an escrow account and they're going to hold on to it and manage it for you. And if you end up canceling for a valid reason, they will just refund that money back to you. How long is your escrow period going to be? So how long will it be from when you get an accepted offer to when you actually own the house? 30 days is kind of industry standard. But again, sometimes to make offers more desirable, we'll cut that down. So a really common length for us, if we're being really competitive here in Los Angeles, is 21 days, 3 weeks. With the right lender, that's still very doable. It's going to feel a little overwhelming because there's a lot going on in those 3 weeks, but it is definitely doable. Anything less than 21 days, if you're getting a loan, is a little tricky. If you're buying all cash, one of those amazing people who has all cash, then you can do it very quickly. I mean, it could be a week or even less. But again, I don't recommend, you always need to give yourself enough time to get through the process. In the offer, you will also specify the length of your contingency period. So these are time periods stated in the offer in which you as a buyer may walk away from the house without losing your deposit. So you can choose to cancel. So our contingency periods are loan contingency. This is just basically a period of time where you can make sure that your loan is set and that there are no issues with your loan approval. Typically, we would do all that up front anyway, but sometimes things come up during escrow. So we want to have kind of that safety net. Appraisal contingency. This is a period of time where, let's say your appraisal comes in low and you can't come up with a way to navigate either getting the price reduced or getting your loan changed in a way to compensate for that low appraisal, then you can walk away based on that. Buyer investigations. This is your inspection contingency. This is your number one most important contingency because it's the most broad of all the contingencies. So let's say you drove by the house at night and you decided, oh, it doesn't feel safe after all. You could walk away based on that reason alone. You can walk away on almost any reason during your buyer investigations contingency. And this includes all of your inspections, and we'll talk more about that in a minute. Seller disclosures is a contingency. That's where the sellers are going to tell you everything they know about the house. And let's say they disclose that like the neighbor is a complete jerk. That's a reason for you to walk away. So that's another contingency period. And then if you're buying a condo, your HOA paperwork is a contingency period. So all of these periods are specified in your offer, and the seller is going to want those periods of time to be as short as possible, and you're going to want it to be as long as possible. So, if you're really low on price or you're low on down payment, maybe you err on going on the shorter side for your contingencies to try to compensate for whatever else in your offer is not as desirable to the seller. You will also include like what is staying, washer and dryer, fridge, any fixtures in the house, is there a hot tub, anything. That's all spelled out in the offer. And then in California, at least, it's pretty common practice for a seller to pay for a 1-year home warranty on your behalf. And this is really great because almost always within a week of you closing, something breaks. Maybe it was working, like let's say the water heater. The water heater breaks even though it was working perfectly fine during your inspections. It breaks a week after. The home warranty will help you to cover the cost of a new water heater. And it's a way for sellers to kind of help protect themselves from buyers saying, hey, this was working before, why is it suddenly not working? So that's another item that we often include in the contract. So once you submit your offer, it is possible that the seller could just accept it. That's what we want. We never want the seller to counter us in any way. We want them to just take the terms we gave. So I've actually had multiple times where buyers have gotten their offers accepted and then they say, oh, well, we thought that we were going to have a counter offer and have more time to think about it. Or they say, oh, they accepted our offer outright. We must have overpaid. No, if they accepted your offer outright, you did exactly what you needed to do to get that offer accepted without them countering your terms or leaving time for another buyer to come in and swap it. So that's a good thing. But a lot of times in these hot markets, we will see counter offers. And so a seller can counter you in a couple different ways. They can give you a single party counter. That means that they're going to give you a specific counter. And if you accept all of the terms on that counter and you sign it, you are now under contract. If they give you what's called a multiple party counter, that means that there are several different buyers who are getting the same counter or a similar counter. And so you have to respond as a buyer, send it back to the seller, and then the seller will choose the one they want, and then you're under contract. So just a little bit different in terms of how you lock in the sale. If it's a single party counter, you have the power to grab it just by signing it. If it's a multiple party counter, the seller has to sign it back to you. Usually what they will ask for has to do with price. So they will ask for either a specific price or like a specific higher price than what you originally asked for, or they will ask for your highest and best offer. So there's kind of pros and cons to both. If they ask for a specific price and it's a multiple party counter and they're giving this out to several different people, then you kind of know, okay, well, if we all get the same price, we're just sort of resetting the list price. And it's most likely that people are going to bid over that price. So it kind of just starts the bidding war process again. If they give you a highest and best, it's hard because you don't necessarily know what number they have in mind or where to start from. So as a buyer's agent, I'm always trying to figure out, to get the most information possible that the listing agent will share to me, to know sort of where my clients were in the initial round. Were they near the top? What can we do to try and get into that same route? But sometimes you're just going with your gut, and the highest and best price is really one of those situations where you have to go in with whatever is the strongest offer that you feel comfortable making, knowing that if someone else gets it because they went $5,000 over you, you're not going to be heartbroken that you lost to over $5,000. And then the other thing that they can do on counter offers is they can change your terms. So what's really common here is they may ask you to waive your appraisal contingency. And so the appraisal contingency is a little difficult to understand. The way it works is that, let's say you're under contract for $500,000, but your appraisal comes in at $450,000. If you're putting 20% down, the lender is only going to lend you 80% of $450,000 instead of 80% of $500,000. And we have to somehow make up the difference of that $45,000 or whatever it is. So the seller is going to want you to make up that difference by just bringing in $45,000 more in down payment. Most people don't have an extra $45,000 in down payment. So they will ask that seller lower the price. So if a seller comes to you in a counter and asks you to remove your appraisal contingency, that means that they want you to say, okay, if the appraisal is low, we will figure out a way to make it work. We will either bring in more money, or sometimes you can restructure your loan and it will still work that way. So that's something to have a very serious conversation with your agent about before removing any contingencies up front. And this is, again, something that is different from area to area. I know that in Northern California, if there's anyone here from the Bay Area, it's very common to have non-contingent offers, or to have the seller have done, all inspections up front so that they can just give it to you in the hopes that you'll have a non-contingent offer. So it really sort of depends on what the standard is in your area. Okay. Once you have your offer accepted, then again, escrow states you are opening your escrow. So you are required to wire your deposit. Remember, that's 3% of the purchase price into escrow within 3 days. There's going to be loan disclosures from your lender. All of this has to be signed right away. Let me just tell you, the first week of escrow is insane. You're going to have people emailing you, calling you all day, every day. But It's only a week of your life. It goes by really fast. And then that stress really does just completely melt away. So if you can hang in there for that first week or maybe 2 weeks, 10 days, you'll get through it. But there's going to be a lot coming at you. People are going to ask you to be signing a whole bunch of stuff. Your agent, again, your buyer's agent, this is one of those 50 things they do, or it's really more like 1,000. They will make sure that you know what order things need to be done in and what is most important. So that's your agent's going to be helping you to make sure that you get all of this done. Okay, on to inspections. And I know I'm taking a little bit longer than I thought originally. So hopefully you guys are hanging in with me. I know this is a really important one. Oops, go back. So typical home inspections. As a buyer, when you have an accepted offer, a seller is required to allow you to do whatever inspection you want to do on the home within your designated contingency period for inspection. So if your home inspection period is 10 days, you have 10 days to do anything you want, and they cannot stop you from doing it. So in California, our typical inspections, obviously anywhere you live, you're going to do a general inspection. This is an inspector comes and they're going to look at all of the systems of the house. So electrical, plumbing, heat and AC, roofing, foundation, the interiors, everything about the house. That inspector will give you information about how those systems are currently behaving. They will not give you estimates for work. Home inspectors are generally just separate, unbiased opinions about the house. So if your general inspector says, hey, I think your electrical is a little bit messed up, then you want to go into your additional inspections and say, okay, I want an electrician to come by and give me a bid for that work. But the general inspector will take a look at everything. Chimney is another one they'll look at. Anything, drainage, anything at the house, they will look at everything. A sewer inspection. Here in California, sewer inspections are important because we have earthquakes and a lot of our sewers are made out of clay. So when the ground moves, sometimes those clay pipes can shift and crack. And your general inspector typically does not actually look at your sewer line. They just look at the waste lines that are under the house or, under your sink. So you want to get a separate sewer inspector to come and actually scope that sewer line. And the reason this is important is because this is a big ticket item. Like if there's something wrong with your sewer line, you have to dig up. And most people don't know that they're responsible from their sewer line, from their house, at least in LA again, from the house to the middle of the street, you are responsible. So if there's a break in the line and it's in the street, that's really expensive because you have to dig up the street, you have to block off the street, you have to have permits, all of that. So it's important they scope the sewer with a camera. It's a little bit like a colonoscopy, and they'll give you a video of it. It's kind of cool, but it's important to get that. Chimney inspection, if you are someone who wants to use their chimney a lot, then I recommend this. If you're someone who really doesn't care about ever having a fire, it's not necessarily that important that you have an individual chimney inspection, although you do want to make sure you know if the chimney stack itself is sound, if it's structurally okay. You don't want your chimney falling on your house. But I will tell you that almost every chimney has $5,000 worth of work on it that needs to be done because it's just not something that people ever look at. So if you don't plan on ever using it, maybe you just save the money for the chimney inspection. But I use my chimney all the time, even in LA. So we had chimney inspection and we had our chimney, rebuilt after we bought. So it's up to you and what you do. And I definitely felt it was important for me. In California, termite inspections. We always want to have termite inspections because we have a lot of termites. And again, it's something that no one ever thinks about unless they're buying or selling a house. So you would have no idea unless you actually saw a lot of termite droppings. Most people just are not aware of the fact that their house has termites. If it's a house with a pool, I recommend a pool inspection because again, pools can be big ticket items. So you want to know, what repair, you want to make sure that your pool is safe to actually swim in. All right, so these are the main ones. And I would say even of these, in California, it's really general inspection, sewer inspection, and termite that are the main three that we want to do on every house. People ask me a lot about, oh, do I need a mold inspection? Do I need all these extra inspections? I want to use the general inspector as kind of our gatekeeper, because inspections can get expensive. I would say to budget around $1,000 for inspections. And that's just for your kind of main top 3 inspections. Once you start doing all of these other inspections, it can really add up. So you want to use your general inspector to find out, hey, is there any evidence here that you see something that looks like mold or that there's a lot of water intrusion? In that case, maybe you do a mold inspection. Or if you're buying like a hillside home, maybe you do a geological inspection. But otherwise, you kind of save that money to do that. Colleen, I know that I'm running up close to 7. Is it okay if we go a little bit over?
Yeah, it's fine.
Okay.
You know, if people need to hop
Yeah,
off.
of
they can hop
course.
off.
Anybody who needs to hop off, if you have questions and you have to hop off and I haven't answered them, please reach out to me. And I will make sure that I get those answered for you. Okay. You can also pull permits for your house. Permits are public record. So a lot, again, in Los Angeles especially, there's a lot of unpermitted stuff done to homes. So maybe an unpermitted addition or an unpermitted garage conversion. If you want to know what, let's say that the title says there's 2 bathrooms, but really there's 3, and you want to know if that 3rd bathroom was done with permits, you can pull the permit history. It's a good thing just to know for your own knowledge. I will say that many, many, many houses sell with unpermitted things. And it's not always a big deal. It's sort of dependent upon that specific scenario. But it's always good to just know going in, is the square footage on the tax assessor's record the same as the square footage of the home? And then this is a big issue in California. I'm sure it's a big issue in Florida and a lot of other states as well. We are having problems with insurance policies here. So when you buy a home, your lender is going to require you to have a hazard policy. That's a fire policy. And you can't close on your house without that policy being put in place, set to start the day that you close on the house. In Los Angeles, especially, we are having a lot of problems because of fire coverage. We have a lot of severe high fire zones. So it's important that during your inspection contingency, you call around and get a lot of estimates from different companies to find out how much policies will be. And again, your buyer's agent will help you to give you to point you in the right direction as to companies that might be more likely to insure in your area. Okay. And then once you've done all of your home inspections during your buyer investigation period, your inspection contingency, then you're going to bring everything together. So all of your inspection reports that you have, all of your estimates that you've gotten for anything that's wrong, you're going to take those to the seller. And 99.9% of the time, we're going to ask for some kind of seller concession based on those items. And so that can be expressed to you in one of 3 ways. The seller can give you a credit. And the way that works is that they will credit you towards your closing costs so that you keep those closing costs in your pocket and you use it after you own the home to do the repairs. And in that case, let's say you got a $5,000 credit because your chimney wasn't working. You get to keep that $5,000 in your pocket, and then later on you use that to do something else. No one's going to know. So I love credits because they're flexible to you and they help you save money that you have to come up with for your closing costs. If you ask a seller to do repairs for you, then the repairs have to be done before you close escrow, before you close on the house. But the problem with asking for repairs is that you can't necessarily oversee those repairs yourself. And it's very difficult to very specifically word in your request exactly how you want that repair to be done, unless you give the seller an estimate and say, I want this particular electrician to do the repairs that are listed on this estimate. Other than that, it can be very tricky and you may not be happy with the way that the repairs are done. So just be careful about that. You can also ask for a price reduction, which is what most people think is kind of the first line that you would do. But asking for a price reduction, if you really need to do repairs to the house and you need the money to do the repairs, the price reduction isn't really going to help you because it'll only take, $20 or $50 off your monthly payment. It won't give you that money in your pocket to actually do those repairs. So if there are repairs there that you feel like you should be compensated for, but you don't care about doing them, then you might take a price reduction just to lower your property taxes. But otherwise, I feel like getting credits is usually the best way to go. So once you have negotiated your credits and you are going to start removing your contingencies. So it's important to note that contingencies, if you're supposed to remove your inspection contingency on day 10, you have to sign something, again, state of California, you have to sign something that removes that contingency. You can't just, it doesn't just go away. So if you're still in the process of negotiating with the seller at that point, the contingency period will just naturally extend, usually. A seller can give you what's called a notice to perform, which will say, hey, you haven't removed your contingency. You have 48 hours from getting this notice. And if you don't remove your contingency, then we can cancel the sale. Even if that happens and you still don't remove your contingency, they can't keep your deposit because you haven't signed your contingency away. The only way that a buyer's deposit is at risk is if you have removed all of your contingencies, it's, the end of escrow, you're about to close, and then you just say, no, I don't want to buy this house after all. In that case, then your deposit might be at risk and you might need to go to mediation, arbitration to determine if the seller gets to keep a portion of that. But in general, there are many more protections for you as a buyer than there are for sellers. It's very difficult for sellers to kick buyers out of a transaction, but it's very easy for you to walk away as long as it's within those contingency periods. So once you've removed all your contingencies, you're in the home stretch. And the only things you really have left to do are your lender throughout this whole process is going to be asking you for updated bank statements, even though you gave it all before you even started the process. They're going to ask you for more stuff. So you have to just make sure that you respond to your lender really quickly with anything that they ask for. They have something called a closing disclosure that you have to have signed, and there is a 3-day wait period between when you can sign that closing disclosure and when you can actually fund your loan. So a lot of the last week of your escrow, it's sort of a domino. You have to do this first, sign the closing disclosure, then you sign your loan docs, then your loan funds, and then you close. And you do have to then wire in the remainder of your down payment and any closing costs. That 3% that you put in at the beginning, that is just a prepayment of a portion of your down payment. So if you're putting 20% down, your 3% went down within 3 days of your accepted offer, and the remaining 17% comes in at the end. You also get to do a walkthrough before you close to make sure that the house is still in the same condition as when you made your offer. But that's pretty much it for at least our process in California. On closing day, you're not, unfortunately, I know it looks fun on HGTV, but you're not like sitting around a table signing documents and then they just hand you your keys. There isn't anywhere you have to be on closing day. The title company rep will go down to the county and record the house, record the title in your name. And at that point, you own the house officially and your realtor can give you your keys to your house. So, that is a lot of information. I understand. It's a lot to go through. And that's, again, why it's so important to do this ahead of time and to ask these questions, over and over again. I talk through this with buyers, but then as we're going through the process, I'm going to reiterate everything I just said at the appropriate moment through. So I'm going to go through now and try to answer some of these questions. And if you have any more questions, please just throw them in the chat. So let's see. Okay, first question. What's the difference between buying a house and rent to own? Good question. I will say rent to own is exceedingly unusual, at least in my area. I don't know about other areas of the country, but in California, I have never done one. I have never heard of any of my colleagues ever doing one. Um, Partly the reason for that is that, I got my license in 2011, and the market has, the prices in the LA area have gone up the entire 13 years I've been in the business. Even over the last couple of years where we saw a major, post-pandemic major slowdown with interest rates going up, prices did not fall significantly. We dipped a bit. There was about a 6-month period where prices dipped a bit, and then they came back up, and we are now, continuing to go up. So a rent to own situation is basically like you agree to a contract with the seller that you are going to live in the house and that your rent is going to be a portion going towards your down payment, and there's everything is detailed out in the contract as to how long you're going to do that before you own the house. And it's not necessarily in a seller's best interest to do that, because it means that the house doesn't actually sell until several years or however long that period of time is. And usually in that period of time, the value of the house goes up. So why would they want to lock themselves into a lower purchase price for that long? So it's really not a common thing, at least in my area, but it may be in your areas. So definitely, talk to your local agent. And again, if you hopped on after I said this, please type in where you guys are in the chat, so I can see, what states you're coming from, and try to give you some specific state info if I can. Okay. Next question. Do you recommend staying somewhere for 10 years to get the most out of your investment? That's a really good question. No, you don't have to stay there for 10 years. I did personally, but I will say the vast majority of people do not stay in their first home for 10 years. I usually recommend that at a minimum, you commit to staying in your first home for 3 years, unless you have to move or some unexpected life change. I would say most people stay between 3 and 5 years in their first home. And if you can commit to 5 years, you're going to get more out of your appreciation. But no, you do not need to, in your mind, be committing to staying in a home for 10 years. And especially, depending on what is happening with the market. So, my buyers who bought in 2019, gosh, the market went up like 30% in 2021. So they were able to sell in like 3 years and make a huge profit on their home. So it is somewhat dependent upon how fast the market appreciates. If you know you want to move and the market has appreciated well for you, then maybe you don't need to stay 5 years. Maybe you don't even need to stay 3 years, but I do recommend staying at least 2 years, because you have tax implications if you sell and haven't had your home as your primary residence for at least 2 of the last 5 years. And basically that means that you're going to have to pay capital gains on anything you make on the house if you haven't lived there for 2 years. For most people, you want to stay there 2 years anyway, just so you can at least break even, because even with your home appreciating, you're still going to have to pay closing costs. So usually you're not going to make a ton of profit if you sell after 2 years. If you sell after 3, 4 or 5, then again, depending on the market, you might find that you actually make a really good profit on the home. Okay. Do you recommend you stay it unless you build it? Again, would love to build new construction homes here in LA. We don't see them very often, but middle of the country, again, very different. And again, that's a question for a lender, but just know, people ask me a lot like, oh, well, what if I just bought land and then I built a house on it? Generally, lenders will not loan you money to purchase vacant land. So you would have to have the money to purchase that just in cash. And then you'd also have to somehow have the money to build the house. So just be aware of that. Okay. Do I have any special guidance for all or mostly cash purchases? Yeah. We own our current house outright, but are hoping to move. We have considerable assets, but we'll obviously need to sell our current property. We have excellent credit, but most of our income is from investments. Yes, okay, so if I understand this correctly, this person, Dennis, wants to move. Okay, so you own a home currently, you own it outright, you want to move. This may be, and I'm not sure if I'm reading this correctly, but I think you may be asking about, buying first before selling. But whether you're in a situation where you're going to buy outright first and then sell your home, or if you just happen to have a lot of assets and you want to buy all cash, I will tell you the process is so much easier if you buy all cash. Real estate agents love you because of that. It's for most people not an option. If it is an option for you, it's a great way, of course, to not be paying a lot of interest. And again, you should really be, talking to your financial advisor about, is it a smart move to pull that much cash out? And you want to think about what your long-term goals are for the property. If it's like an investment property and you're going to be renting it out, is that going to be, I think it will depend on how long you hold the house. If it's a long-term investment, then it's probably going to end up being more profitable in the long term when you consider the appreciation of the house on top of the monthly savings from not having to pay interest. But again, it's really more of a question for your financial advisor. But from just a process standpoint, all cash offers are easier because there's no lender involved. So you're not required to have an appraisal. We're not waiting on documents to come in from a lender. Basically, you as a buyer will come in, you'll do your inspections. All of that will be the same. But once you have signed off on your inspections and you say, okay, I want to buy the house, you literally just send the money in and you close. And so agents tend to find that very desirable. I will say, though, there's a perception that if you're buying as an all cash buyer that you're going to get like a better deal on the house. And that's not necessarily the case in competitive markets. So you do still have to be prepared to pay market value for the house, but sellers will sometimes accept all cash offers that are not their highest offer because of the benefits that a cash buyer can bring to the transaction. So hopefully that answered that question. If not, please type in more, or we can talk after. Great question. These are all such good questions. Would you recommend lining up inspectors before offers are submitted? Is that something an agent can help with? Absolutely. This is definitely another one of those things that buyer's agents help with. I have a whole team of inspectors that I work with very often. And a lot of times I'll just, my buyers will say, hey, could you just set this up for me? I do all of the calling and set everything up and coordinate everything for them. You don't need to do it before your offers are submitted. So I'm not sure exactly if the question here is, should you do the inspections before you submit your offer versus should you just have them set up? If you are considering putting in what we call a non-contingent offer, so an offer where you don't have an inspection contingency, if the listing agent and seller allow it, you could do an inspection on the house before you make your offer so that you're more confident making that non-contingent offer. But the seller has to allow you to do that. You may not necessarily have time to do it. And also it's a cost. It could be $600, depending on the size of the home. I would say general home inspections are usually between $400 and $600. So that's money that you're spending without knowing that you're actually going to be purchasing the house. So I don't necessarily recommend doing it ahead of time. I don't know that you necessarily need to. But oftentimes, if I'm in negotiations on an offer and I know we have a really short time frame to get inspections done, I will, on behalf of my client, put my inspectors on hold for a certain day so that I know once we get the accepted offer, we can move right into the inspection process and not be delayed. Okay. Do you have any experience with or advice for a group of 3 people looking to buy a house together, not all married to each other? Yes. I mean, I would say most of the time we're looking at like maybe a couple and then a parent. but it's really no different at all. It doesn't matter if you're in a romantic relationship or a romantic partner with someone. The process is the same. I would say if you're all looking to purchase together, to just really make sure that you talk about what your goals are, your long-term goals for the house. Because if, you know, are you going to all be living there? Is it going to somehow be an investment for someone? You have to really be on the same page about how long you think you're going to be in the house, because otherwise, if someone wants to cash out and get their money, then either the other two people are going to have to buy that person out, or maybe that person is just stuck in the house. I mean, you have to all together have some kind of agreement as to what will happen. And part of this is how you take title. You're going to take title as probably tenants in common. There are a bunch of different ways to take title. You can take title as, you know, husband and wife. You can take title, you know, there's many different situations, and it will explain how, like, let's say, unfortunately, one of the three people passes away. What happens to their share? Does it go to their heirs, or does it go to the other people? So that's all very specifically laid out in the buying process so that you will know how it will work. Otherwise, the process is pretty much the same. So it's really just you, if you're buying with two other people, you all have to have an agreement between each other as to how things are going to work, and make sure that that's all expressed in the paperwork. But otherwise, it's everything that we just went through. And there's no problem at all with having three people qualifying on a loan together. The more, the merrier for loans, honestly. Especially if someone has bad credit. You know, it's kind of the same situation as a co-signer. And again, I'm going over time. So if anybody needs to drop off, please just reach out if I haven't gotten to your questions. Okay. I see some more LA people. Okay. Any other specific questions that anybody has? I don't see anything else popping up. You're probably no, there's probably nobody left on this call. I don't know who's left.
No, there's still 12 people.
Oh,
No,
okay. Thank
this
you
is
for hanging.
great. Thank you so much for doing this, Kari. I should put my camera back on. This was so awesome. I think it's like just something that everyone always has questions about, and it just makes a lot of sense. So thank you so much.
Of course. I mean, I so appreciate everybody taking the time. And again, I think Colleen put my info in here.
I did, and then you know what I'll do? I'll email everyone tomorrow, and I'll include it. Do you want me to include the link to your presentation as well, or no?
Sure.
Okay.
Yeah, absolutely.
So I'll email that to everyone tomorrow, so you'll have that.
Yeah, so, you know, especially those of you who are in the LA area, please feel free to reach out to me. I work the whole LA area, so I can really answer questions about neighborhoods or the process here. And if you aren't in LA and you just have more general questions, please reach out as well. I'm always happy to connect with other musicians. I love my Berkeley alumni. So thank you all so much. And I will definitely, oh, you guys are so nice. Thank you for your comments. And yeah, I would love to talk with you more. So anytime.
Thanks, Kari. I hope you all have a great night. Thank you for being here.
Okay, thanks guys.